on why the markets have been on this stellar rally and whether that is going to continue. And who are the players this time around? We have been seeing normally it's the large cap or your blue chip stocks that really lead the rally when we get into this, big rally or long rallies that we see. But this time around, the picture is different. And why is it so? Well, we have to see who are the ones really putting in the money, where is it coming from, and why, and whether now is the right time to be looking at the other, not the benchmarks, but the broader indices, and if there is a party there and whether you need to be a part of it. And joining me to discuss all of that is Feroze Azeez, the Deputy CEO at Anand Rati Private Wealth Management. Good morning, Feroze. Thanks so much for joining us live here at Money Control. Let's get talking about first at length the report that you all recently put out and whether this is the right time to be increasing your small cap allocation. But we'll get to that first. Let's first look at the big boys and how they are performing in the benchmarks and give us a sense of where you're looking at the benchmarks at the current level and whether you think 20,000 is not too far away.
Hi, good morning, Stacey. Point one, yes, like you rightly said, the markets have rallied from the March lows. Markets always have this tendency to bottom out. If you can identify those periods where there's signs of those bottom outs, you would be able to enter the market and not be hesitant when the market's correct. So when Nifty had touched about 16,900 odds in March, the FI net short position was so high, 91%, which implied that there was more shorts than longs in the market. And if there is any good news, then there will be short covering. And that led to more short covering and more good news coming in. And today we are at the peak. So 20,000 isn't too far. I'm sure markets have the tendency to test the psychological markets before they correct. So that's a high probability event. Of course, there's no certainty of anything when you come to investing or capital markets. That's point one. Point two. I think, like you were also mentioning in the earlier part of the show with your other guest, that there are some sectors which have not contributed to this rally, and IT is one of those sectors which is now, after the results of 3 to 4 Nifty companies in the IT space having given away, that's also showing bottoming out kind of signs. So there will be newer contributors for Nifty's next leg of growth. Earnings have supported. We were one of the first to predict an earnings of 772, 775. It ended up at 772 from 530 in the COVID year. So I think earnings last year closed about 816, 17. If you remove the Axis Bank acquisition of the Citi business, then the Nifty earnings were 835, 840. So we are looking at 930, 936. So if earnings support, I think the rally is not just liquidity driven, but fundamentally backed with corporate earnings, which is the pillar on which capital markets stand.
Right, and like you're saying, corporate earnings are going to be the one really pushing that. We have some big names, lined up. We have Infosys, we have RIL, ICICI Bank over the weekend. How do you think these are going to be the ones that are really going to push this market or really take Nifty to 20,000 and then set it forward from there?
See, I think what's been seen in the IT, now if I go with the Infosys kind of expectation, not just from a stock perspective, but what we've seen is, of course, the results which have come from the IT sector so far have not been beautiful, have not beaten the expectation, but still you see markets having given some thumbs up to those stocks. That implies that the expectations were reasonably muted. And that's when you see when a bad results and the stocks move and the sector moves, that implies that you're almost bottoming out. So that's point one. So I don't expect a huge great quarter from Infosys, maybe, if you extrapolate what's happened so far in terms of the results season. But I think one thing which is very clear, IT sector is driven by revenues of larger deals. And US seems to be far more optimistic than the last time I visited in December. So point one I'm making is there is signs of bottoming out. Not that you will get a great quarterly result this quarter from the IT sector like you've seen. The other 2-3 Nifty companies which are from the IT sector are still to produce results for the last quarter. But what's important to note is that the revenues are seemingly robust, and that's why you've seen consistent narrative of a good guidance being able to be achieved. I think 3 to 5 years, IT as a sector growing at 12-14%. Seems quite likely. I think the only question mark is the margin, which I'm sure they will be able to manage.
Right. Also, let's shift our focus towards consumer discretionaries. Now, we do have HUL who will also announce its results tomorrow. How are you looking at that whole rural recovery? Are we seeing that back on track? And are we looking at consumer discretionary now, actually pushing towards growth, getting those numbers, volumes increasing? What are you looking forward to when it comes to FMCG stocks, at least?
See, I think if you have to understand rural demand, and if you look at agriculture, GDP growth is about 4% and I think that's going to happen this quarter, this year as well. Last time we have marginally beaten the GDP expectation. So, of course, the service sector has contributed the maximum growth in the GDP. So that's not from the rural space, but agriculture seems to be the growing at that 3, 4, 5%. So point one I'm making is, of course, the rural demand play will happen, and it's happening as we speak. But of course, when you look at HUL as a stock or any large stock which is a part of Nifty, there's a lot of index fund investing. So index fund investing is practically the stock is out of the capital market. So I would see it in conjunction with promoter equity, because once a index fund manager buys it, it's not opinion oriented. It is a mandate. So unless the fund loses money to redemptions, that money is going to stay there forever. So that specific quantum of free float is disappeared for long periods of time. So they will command a higher PE, but I don't see very, very stupendous growth. But I think because of this whole self-fulfilling prophecy of more money coming into index funds and more free float getting absorbed by index funds for good practically, is going to keep them at a higher valuation for long periods of time.
Right. So you are seeing rural recovery play out, at least in this quarter. Will that also convert, and will we see that also play out for auto stocks? Today, if you look at the top losers, they are among the auto counters. So what is your view on the auto sector, and should one be, looking at them right now, or should we wait and play those games for post earnings maybe?
See, unlike an IT sector, auto sector is a very divergent sector. So it's very business specific. So if you ask me on a generalistic basis, I think the rural demand is going to help the auto sector. And there's several other things which will help the auto sector. So I would be bullish on the auto sector, but being more stock specific in the auto sector is a prudent strategy, because each business has a different segment and different market they're catering to. So I would say auto sector in general should be an outperformer to Nifty over a year-to-year period. But there it's more critical to be more stock specific because of the divergent business segments.
So Feroze is telling us to pick and choose what we want from the auto sector, not the sector as a whole, but particular counters that you need to be looking out for. But Feroze, can you tell us more about this report that you all have put out on small caps, and whether one should be increasing their allocation now towards small caps? What is the rationale there, and why should one be actually looking at it? What are the reasons that this will really play out for the benefit of our viewers?
See, if you have to derive inferences from mathematics, it's reasonably clear that small cap as an index can do well. Why? Because firstly, when you look at each stock and its earning, I'm giving you small cap as a proxy is Nifty small cap 250 as an index, which we analyzed, and we looked at each constituents and their earning growth potential and target prices. It has a relative better outperformance of about 5 to 6% vis-a-vis Nifty on a like-to-like basis. That's point one. Point two, last 5 years, small cap has underperformed Nifty for a quantum of 4% per annum, which is a reasonable underperformance for 5 long years. And that has seldom happened. If you look at whenever this has happened, it has happened 221 days out of the 736 days we analyzed. We saw that the subsequent 3 years, small caps have outperformed every single time. So, of course, future is something which history can't dictate. But history can give you some degree of probability assessment. So that's why the odds that small cap will outperform large cap over a 3-year holding period is reasonable. That's point two. Point three, there is a strong correlation of domestic flows and small cap and mid cap segment movement. I think domestic flows are going to be robust from an institutional standpoint. We had 14,700 crore SIP number. I had called for a 25,000 crore number when this number was 7,000. I think we are headed towards a 25,000 crore monthly systematic investment plan over the next 3 years. So that will enough liquidity to these two segments, largely the small cap segment. And when FIIs pump in money, you see a strong correlation between FII movement in and the large cap stocks. So these are the three out of the several reasons we analyzed to come to the conclusion that the probabilities are stacked up in your favor for small cap outperformance to Nifty over the next 2-3 year period.
Well, thanks so much for that, Feroze Azeez of Anand, Rati, giving us what he thinks would really make those changes for the Nifty, whether we're headed and how to be riding this bull run. Well, with that, it is a wrap on Opening Bell. Thanks so much for tuning in.